Welcome to Bloomberg ETF IQ. I'm Katie Greifeld. Scarlet Fu is off today, so it's just me and Eric. So let's get you to the biggest stories right now in the more than $14 trillion global ETF industry. China's latest finance briefing underwhelms as investors wait for more stimulus details, with China ETFs falling over the past week. We'll speak to Jodi Love. She is lead portfolio manager for 4 active ETFs over at T. Rowe Price. She speaks to us about the attractiveness of these ETFs and mid-cap stocks. And the tax-efficient ETF market, about to add a new one to its lineup. We'll talk about it with Cambria's CIO and co-founder Faber on the upcoming tax fund. That's its ticker, tax. It's very clever. As always, though, Eric Balchunas from Bloomberg Intelligence here with us now, looking at the flows. Eric, what do you got?
Katie, yeah, look, a lot of China in the flows here. You're going to see right away. But before we get to China, VU at the top, man, relentless. Another 2.5 billion. This thing has 75 billion now year to date. The record for an ETF ever is 50, so it's 25 billion beyond the record, headed to 100 billion. Unbelievable. And we have a note out today about how all the S&P 500 ETFs have taken in over $200 billion this year, if you include mutual funds, which is a record. So 23% returns in the S&P, obviously going to lead to flows. And you see there the Qs and IVV also getting some bids there because U.S. markets are generally pretty good. But look at the China, FXI. You never see FXI appear, and you never see Asher. That's 8 shares and A shares, both in the top 7 here. More on that in a minute. Let's look at the outflows first. And there is a little bit of bearishness here with the SPY seeing some outflows and VTI. I would say HYG is a little risk off there. Not much, though. These outflows are overwhelmed by the inflows. So I'd saw it net bullish, but not completely. Let's look at China a little more in depth, because if you think about China, right, the record month for China ETFs in 20 years is 4 billion. They've taken in 10 billion in October already. So even if there is not the greatest returns in the past 2 days, people are still piling in. So let's look at the 1-month flows by ticker. This is interesting because China is a really unusual place to invest. FXI is 8 shares, 6.2 billion. That would be a record month if it stopped right now. Asher is A shares, only the shares locals buy. You can now buy this. That would be a record as well. KWeb, this is tech companies which take you across shares, even red chips and P chips in there. That would be a record. Yin, this is 3x China, right? So jacked up China right here. That would blow away the record. And then MCHI, this is the one advisors like, holds all of those shares in one shot. It's like the easy button for China, 1.2 billion. So Katie, flows galore here. It's almost like a feeding frenzy because of that QE program that's been implemented.
All right, Eric, thank you. And let's keep the conversation going now with Jodi Love. She is lead portfolio manager for 4 active ETFs over at T. Rowe Price, joining us on set. It's great to see you, Jodi.
Thank you so much for having me on the show today.
So you manage a whole range of strategies. I want to start with your small mid-cap ETF, though. The ticker there is TMSL, because when it comes to that size tier of the market, the SMIDs, if you will, it's been a real hot and cold sort of rally. Investors like it, and then they don't, and it's just been a lot of back and forth. What are the components, the recipe that you need to see for a sustainable rally in that space?
So with recent rate cuts, we ultimately continue to have belief in a soft landing scenario. Typically and historically, as rates go down, small and mid caps have a great potential to outperform in that type of environment. There's been a real divergence, as we know, between large and small and mid-cap performance for quite some time. To be fair, much of this divergence is actually deserved due to relative weaker earnings growth in small caps versus large caps, and valuations have been low as earnings results have been really muted. On the other side, we've seen massive performance on the large cap stocks, particularly driven by Mag 7 outperformance in the large cap tech space, which I'm sure we'll talk about in a little bit as well. And we believe that given rate cuts, given we are at somewhat of a trough for earnings deceleration in small and mid cap stocks, that we will now start to have a scenario where earnings can significantly accelerate in the small and mid cap space and ultimately have the opportunity ability to surpass large cap as a sector in terms of outperformance. We think and have been thinking for a little while, although probably a bit early to the thesis, that we would see a market broadening, both in the large cap space, but particularly in small and SMID. And so we believe that our SMID ETF, TMSL, is really primed to take advantage of a re-rating in stocks, given what we believe will be an earnings acceleration, especially for higher quality growth and core stocks, as well as stocks that potentially have had some trouble. They'll benefit from lower interest rates, et cetera.
And, you know, it's interesting. My colleague David Cohn did a study. He found that small cap managers were cheating upwards. Used to be large cap managers would cheat downwards and get that size factor. But now they're cheating with mid and large caps, and that's become how they outperform. So you have SMID, so you're allowed to cheat up. But I guess my question is, the reason for this, our theory, is that less IPOs come into the small cap space, so you're left with all the rejects. And that's why it can never get going, because companies wait an IPO when they're big. What's your thoughts on that?
So I think that we're excessively lucky at T. Rowe Price because we ground everything we do in fundamental research. And so what really differentiates us as an active ETF manager versus a passive ETF fund that just tracks an index, so could potentially track Russell 2000 Growth or Russell 2500, some of the smaller bench indices, is that we understand stocks that don't have earnings power, that are negative earners, that might have really high debt. And so we have over 300 research professionals globally in 20 countries who aim to figure out the best insights in the small cap and mid cap universe. So we really try hard to stick to our bandwidth and don't cheat. We do lean a little bit more mid cap than small cap, but our holdings range anywhere from stocks that are sub $1 billion up to about the mid $20 billion. But when we had some outperformance of those stocks earlier this year, our ETF launched June of 2023. In the market sell-off, particularly in small and mid-cap stocks, we really leaned into some of our favorite names. They appreciated. So as we trim some of those, as they get, to your point, above sort of that cheating range, we are definitely looking for new ideas that we can bring into the portfolio because there are so many great opportunities in this mid-cap space.
Well, it's really interesting to hear you say that you're leaning more mid-cap right now when it comes to TMSL, because the conversation I have around small caps all the time with various investors and analysts is that basically if you take a look at the Russell 2000, for example, it's gotten a lot junkier. It's lower in quality, just the small cap area. So, I mean, my question to you is, how active are you when it comes to this fund and you're evaluating the fundamentals here?
We're extremely active. We actually have over 75% of active share in our TMSL ETF. It's benched against the Russell 2500. And as I noted a few moments ago, our ETFs leverage the depth of the T. Rowe Price research platform. So we follow all the benefits of what has benefited our performance and our mutual funds for the last 8 decades. We have weekly research meetings. We sit down with our co-portfolio managers on the strategies, all the analysts on the strategies, to continue to take advantage of small, SMID, and mid-cap stocks that we believe will outperform over the long run.
Let me ask you about, there's a line in here, and this is really interesting. You guys meet with CEOs and CFOs, old school, right? There's so many ETFs that are passive, right? They don't meet with CEOs. And then smart beta and the quants, they don't care, just looking at data. Is there anything or any alpha or edge anymore in actually meeting with the people, going to the plants, and being on the ground?
Oh, we definitely believe that is our edge. T. Rowe Price's North Star is our industry-leading research. Before I took over as a portfolio manager for these active ETFs, I spent 20 years of my career being an investment analyst. I covered many different sectors, and I spent a good part of my time on the road. I could tell you really, really funny stories, but like nothing beats on-the-ground research. I covered consumer for a long time. I used to go to malls before Amazon existed in the early 2000s.
The dark days.
Yes. And we would go, and I'd go on Black Friday, and I would get there at 6 a.m., and I'd see what all the Black Friday specials were. And I had a spreadsheet that I compiled over 15 years of doing this. And so I could go in and say, wow, this company only did 15% off on Black Friday last year. This year it's 60% off. So their margins are in trouble, and or they have too much inventory, and there's definitely a risk you can miss earnings. And so we believe that we can really take advantage of our long-term time horizon by not only getting the insights, but being able to translate them with our crystal ball into future insights and ultimately picking better stocks for our clients.
All right, kicking it old school over at T. Rowe Price. Jodi, it's great to see you. That, of course, is Jodi Love of T. Rowe Price. Now, coming up, as Eric mentioned, China pledges new stimulus and massive flows hit Chinese ETFs. We'll discuss next. This is ETFIQ on Bloomberg. All right, welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start, of course, with BlackRock. Of course, BlackRock reporting earnings on Friday. And one of the big headlines was that their AUM is now $11.5 trillion. That is a record when it comes to their AUM. And that's before, of course, some of their deals in the private markets actually close. So it'll be fascinating to see how these bars change as that starts to get realized. But let's also talk about the S&P 500. Talking about really big things. BlackRock over to the S&P 500. It's the biggest benchmark for a reason, because you're taking a look at mutual funds and ETFs that track S&P 500 assets. And as you can see, at least on the product side, the number of funds, it's a pretty even split between ETFs and mutual funds. There you have it. Let's also talk about China, and in particular, China ETF volume. You're taking a look at combined trading volume for yin and yang. These are two ETFs leveraged 3 times, both to the upside and the downside. And you're taking a look at volume here. As you can see, we had 3 huge weeks, a little bit of a drop off now. So where we go from here, let's turn the conversation over to Bloomberg's Carolina Wilson. And Carolina, of course, you're tracking this very closely. And I'm curious, after the stimulus, this sort of drip feed of stimulus measures that we've gotten over the past couple weeks, what does the appetite for Chinese ETFs currently look like?
The appetite is really just through the roof, Katie. I mean, after months and months of writing about how investors were avoiding China exposure, really pouring money into EMX China strategies or India-specific funds as a growth proxy for emerging markets, these stimulus measures really brought cash back to this market of China ETFs. And the usual suspects are front and center here, FXI, that's large cap Chinese stocks, KWEB, that's internet China stocks. And as you mentioned, even the leveraged products like yin and yang have seen record inflows. And that's not only the most on record for these strategies, period, but in many cases more than double the inflows compared to the previous record. So I just want to highlight the magnitude here, right? We're talking about billions of dollars moving with this news. And what's also worth pointing out is that it's not all bullish activity. So again, the latest, we had China's finance minister vow more support for the real estate sector, but stopped short of that headline figure that traders were really looking for to feel even more optimistic about this. So what that's going to do is inject volatility and uncertainty into the market. Volatile scenario is exactly the sort of environment where leveraged products thrive. And that's where you're going to see that outsized volume that I would expect to continue for funds like yin and yang, where traders are really looking to take these very directional, very short-term tactical bets on the direction of the equity market.
And one thing that I've been trying to keep a tab on is that the retail investors in China, all of this is so they actually invest in the market, because they were trying to invest over here. They were rushing to buy the Qs and sent all their local ETFs to premiums because they wanted the U.S. so bad. Looks like now they're finally staying home and investing there. How important is that for the foreign investors who want to ride this wave?
I think, when you have any sort of news that's going to bring volume back to the market and liquidity back to the market, you just see this heat rise around these products. And not only in the terms of inflows and outflows, which is typically the sort of behavior that you'll see from the retail investors, but also even in the derivatives market, right? And it's just a sign of the proliferation of how this ETF market has matured and grown, where we not only see retail investors or local investors in China investing in funds in a pure inflow and outflow relationship, but also just the derivatives market, the put and call options on some of these funds spiking, again showing that these tactical hot money traders are also back to this market and looking to take these really directional bets on the direction.
All right, Carolina Wilson, great to see you again. That, of course, is Bloomberg's Carolina Wilson. And still ahead, we'll drill down into the upcoming tax ETF with Faber of Cambria Investment Management. And a reminder, of course, that you can listen to Eric and Joel Weber on Trillions. That's their podcast that covers the industry. Much more ahead. This is ETFIQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time for today's drill down, where we focus on one ETF. Eric, what do you got?
Katie, today we have an unusual situation. We have an ETF that actually hasn't come out. It's just a filing. But every now and then you get these sort of earthquake filings that get people chattering in the industry, and this one did it. This is the Cambria Tax Aware ETF. Now, ETFs, low cost, liquidity, but tax efficiency is huge for most investors outside of DC plans. And this is sort of saying, look, a lot of big institutions will convert a separately managed account right into an ETF and then use the creation and redemption process to manage and defer capital gains. It's big for them, and that's why you see a lot of SMAs converting to ETFs. This is saying, hey, why let all the big guys get to do it? Why don't we let little investors do this? So it's allowing all these little investors to convert their separate accounts wherever they're located, like Schwab, into the ETF as if they're seeding the fund, and they can also benefit from these deferred capital gains. So just another novel approach, Katie, of the ETF structure, especially on the tax front.
All right, Eric, thank you. And joining us to talk about this ETF is Faber. He is co-founder and CIO of Cambria Investment Management. So a couple points here. One, I can't believe that the ticker tax was available. That seems amazing. Two, Eric did a heroic job explaining this ETF, but for a lot of people, it's pretty thorny. So let's talk about it. So swap funds exist. My understanding is you're basically putting it into the ETF wrapper. And I'm curious how you're finding the so-called seed investors, if you want to call them that. Is this a build it and they will come situation, or are you lining up investors ahead of time?
You and Eric can see this if you want. We're open to taking your GameStop, and can't take Eric's Dogecoin, sadly. But look, there's a lot of prior art for this. I think if you go back to the early concept of what this actually is, we try to tell investors like, hey, you're very familiar with like a 1031 exchange in real estate. People get that, right? There's been generational wealth for the last 100 years. Exchange funds that Goldman or Merrill may have put out over the last 50 years. But really, over the past 10 years, you've had this 351 exchange. And really, within the last 4, since the ETF rule, which has allowed a lot of the mutual funds to convert to ETFs, private funds convert to ETFs, and what you just mentioned, an asset manager wrapping up some of their separate accounts. The innovation that we're trying to do is say, look, this shouldn't be reserved for just clients of the big boys, right? But let's make this open enrollment. Now, the reason we haven't done this before is trying to corral thousands of investors is not something that we're probably capable of. So we partner with our good friends at Alpha Architect, ETF Architect, Wes Gray and that crew. They have that military efficiency. So they've already done one. With the last one they did had 5,000 accounts. But we're going out trying to educate the marketplace because not really many people have heard of this before. I think if you move out, take this to the logical conclusion, a year or two from now, probably most ETFs will be seeded in this way. But we've actually filed for a group of 3. So if you don't like the first one, you can enroll in the second one in 3 months. If you don't like that, you can enroll in the next one 3 months later than that. But really, this first one, we want to make sure the plumbing is right. We want to make sure it's smooth and make sure that we get the process down. But it should launch in December. And so the way we take interest, you email me or you go to CambriaInvestments.com/tax and put in your information, and we'll have a chat.
So, Meb, here's where I get a little lost. Say I'm sitting on this Schwab account. I have, say, 10 stocks. Now, I'm one of 100 people who decide to enroll. Other people aren't going to hold the same stocks. So you're going to get this sort of diverse collection of stocks. So how does my actual investment change? If I had, say, something close to the Mag 7, I convert into this. How is my actual returns going to differ, and how is that worth the tax trade-off?
Yeah, there's a couple rules. So you can't just contribute all your NVIDIA, right? So the two main rules you need to be aware of are, one, the top position can't be over 25%. So you can't just contribute one stock. Second is any position that's over 5% can't be over 50%. So again, the easiest way to think about it is you need a somewhat diversified portfolio, but ETFs are look-through. So you could contribute 100% SPY, for example. Schwab is a great brokerage, easy to work with. But in general, let's say we corral everybody at Bloomberg. We got 100 people or 1,000 people. They throw in all these portfolios, and it transitions to the ETF. You know, whatever the prospectus may be. Our first fund for tax is 100 stocks, long only, that avoid paying dividends. This type of fund doesn't exist, so it's extra level of tax efficiency. But essentially, through in-kind redemptions, through in-kind trading, you get to the portfolio that you want for whatever the strategy may be. Our second one is an ETF of ETF strategy, and our third is global shareholder yield. So you will have probably most variant styles, does not have to reflect the exact positions of what people contributed, different than an exchange fund, which is a big mashup of what people threw in.
So, Meb, we have less than a minute left with you, but I mean, obviously this filing set off a lot of conversations in the ETF industry. I've heard some people basically describe it as, you know, you're exploiting tax loopholes. And I am curious, I mean, how confident are you that you actually will launch in December, that the SEC will greenlight this?
What are they going to say? Here's something that rich people have been doing for 100 years, but all of a sudden little guys can't do it now? That's the beauty of the ETF structure. It's democratizing access for everyone. Look, we say every citizen should pay every cent of every tax they owe and not a cent more. It's your duty to yourself, your family, community. You shouldn't pay more taxes voluntarily. Now, if you want to volunteer, I always tell my politician friends, say, look, do you volunteer extra taxes? Do you tip the government when you pay your tax? Of course not. Nobody does that. So it's a thoughtful way to go about it. The big key on this is it's furthering the ETF structure as one of the best things for the individual out there.
All right, Meb, we have to have you back when it launches. Of course, this is a novel new product when it comes to the ETF space. Really thrilled that you could make the time to speak with us. That is Meb Faber of Cambria. And of course, you can read all about this drill down, plus the latest in the ETF industry. If you subscribe to my weekly ETF IQ newsletter, I would highly recommend it. But that does it for Bloomberg ETF IQ. I'm Katie Greifeld, along with Eric Balchunas, and this is Bloomberg.